Wood's share plans offer you the opportunity to own a stake in the future of our organisation. Wood offers employees in the UK the chance to participate in two plans, the Employee Share Plan and the Share Incentive Plan. This presentation aims to provide you with more information about how these plans work, how they compare, and how you can participate. First of all, what do we mean by a share plan? Share plans provide you with a simple way to purchase Wood shares through payroll deductions and benefit from additional matching shares from the company. A share is a unit of ownership in the business, and by owning shares, you become a shareholder, and you may benefit from any growth in Wood's share price, as well as receive dividends, which are a share of the company's profits. You will also be able to vote on shareholder matters at the company's annual general meeting. The Employee Share Plan and the Share Incentive Plan are the two all-employee plans available in the UK. Although they have a similar concept, the structure and the terms of each plan is different. Let's start with the Share Incentive Plan, for short, the SIP. The SIP is a tax-advantaged share plan which is recognised by HMRC. It's your opportunity to purchase Wood shares in a tax-efficient way. To participate in the SIP, you must be employed by a UK entity of Wood and be considered a UK tax resident. You can contribute as little as £10 a month, up to a maximum of £150, which will be taken from your gross pay before tax, which means you make a saving on income tax and national insurance contributions. Your contributions are used to buy shares on the London Stock Exchange on a set date every month, and they are referred to as your partnership shares. Wood will give you one free matching share for every 2 partnership shares placed into the SIP. You must hold on to your partnership shares for 3 years to receive these matching shares. Each time Wood pays a dividend, you will receive this as additional shares, based on how many partnership and matching shares you have in the SIP. Your SIP shares are held in an onshore trust, and if certain conditions are met, there can be further tax relief to benefit from. After 3 years, you can sell or transfer your partnership and matching shares out of the SIP, but you may have to pay income tax and national insurance contributions on the value of the shares. In addition, after 3 years, you can sell or transfer your dividend shares out of the SIP, tax-free. If you wait a further 2 years, so 5 years in total from when the shares were first purchased, you can sell or transfer all of your shares out of the SIP completely tax-free. You can find out more information about the SIP, including a guide and the Frequently Asked Questions document on the website linked on this slide. Let's move on to the Employee Share Plan. To participate in the Employee Share Plan, you must be living and working in one of 17 countries where the plan operates. A list of these countries can be found on the dedicated Employee Share Plan website. At the start of each annual plan, you'll be invited to choose a percentage of your salary between 1 and 10% to invest in Wood shares over the course of a 12-month period. This is known as the purchase period. Contributions are taken from your net pay after tax and are used to buy shares on a set date every month. The price you pay for a share is based on the market value on the day of the purchase. 12 months after the end of the purchase period, Wood will give you one matching share for every 2 shares you own. The matching shares under this plan are considered additional income from employment, and therefore are liable for income tax and national insurance contributions. Dividends are paid on purchased shares and any matching shares which have been released after the 2-year holding period. Dividend shares may also be liable for tax. Shares that you purchase belong to you and can be held for as long as you wish to hold them. You can decide to sell them at any time. However, you may lose any associated match if you sell before the end of the prescribed waiting period. If you do sell your shares, you may need to pay capital gains tax on any profit you make from your original investment. Now that we've covered how both plans work, let's look at how they compare. The first difference is the eligibility criteria required to participate. If you are employed by a UK entity of Wood and you're living and working in the UK, then you should be eligible to join both plans. If you're working on an international assignment, it will depend on your UK tax residency status whether you're eligible to join the SIP or not. For the employee share plan, you need to check that where you're living and working is an eligible country. The next difference is the maximum amount that you can contribute each month. For the SIP, this will be a fixed value in British pounds. For the employee share plan, this will be a percentage of your salary. So if you're on variable earnings, this could differ every month. It's important to note that if you are participating in both plans, then you cannot contribute more than 10% of your salary in total across both plans in 1 year. If you want to check exactly how much you can contribute, you can find a useful calculator online on the Wood Share Plans UK webpage. If you do join both plans and your selection exceeds your maximum limit, we will need to scale back your employee share plan contributions. The next difference is the prescribed waiting periods in place that apply to the matching shares. For the employee share plan, this is 2 years, and for the SIP, this is 3 years. The distribution of dividend shares differs across both plans. With the SIP, dividends start to apply to all shares held in the SIP from the outset. This applies to partnership shares and matching shares, even when they're locked. With the employee share plan, dividend shares apply to your purchased shares and only apply to your matching shares after they've been released net of any withholding for tax after that 2-year holding period. There's also a difference in how the dividend shares are treated for tax. When it comes to the tax treatment of both plans, there are fundamental differences. The SIP comes with tax advantages on both your salary contributions and your shares that the employee share plan does not offer. So this is an important factor that you need to consider. You can refer to our tax guidance documents on the website for more information. The SIP is only offered to eligible employees in the UK. When you leave the UK, or you're no longer a UK tax resident, your contributions will need to be stopped. However, you can leave your shares in the plan and you may still be eligible for the matching shares. With the employee share plan, you can only continue to contribute if you still meet the eligibility criteria. Your payroll deductions can still continue and you will still be eligible for the matching shares if you remain eligible. If you move to an ineligible position, you will need to leave the plan. However, you may still be eligible for the matching shares. If you leave Wood, you can no longer continue to participate in any of the share plans. And depending on your reason for leaving, there may be an impact on your eligibility to receive the matching shares and the tax advantages that come with participating in the SIP. There is a dedicated guide for leavers on the Wood Share Plans UK webpage, which will help you confirm whether you are still eligible for the matching shares and the tax relief. Finally, it's really important that you update your contact details on your Equate Plus account when you leave. Ideally, this should be with a personal email address so that we can still reach you by email after you've left. Wood and Computershare may need to contact you at points in the future where you have an action required. Thank you for listening.